A year of muted growth often signals reason for concern. For Panasonic Manufacturing Philippines Corporation, however, it also reveals a story of deliberate control and resilience in the face of mounting competitive pressure. For the fiscal year ending March 31, 2026, PMPC reported net sales of 16.14 billion pesos, down 4.5% from the previous year. Net income also declined, falling by 9.3% to 472.9 million pesos. Earnings per share slipped to 1 peso and 12 centavos. In response, the company's board approved a more modest cash dividend, 67.9 centavos per share, mirroring a cautious outlook in a challenging year. These headline numbers reflect a complex environment. Port congestion, weather disruptions, weaker fourth-quarter demand, and a sharp drop in export sales, especially to Taiwan, all contributed to softer results. Yet beneath these challenges, PMPC's management moved decisively to protect margins. While sales declined, cost of goods sold fell even faster, lifting gross profit to 3.33 billion pesos and improving the company's gross margin to over 20%. This operational discipline offset much of the top-line weakness. At the same time, rising general and administrative expenses, driven by higher provisions, salaries, and asset write-downs, still weighed on bottom-line earnings. Perhaps PMPC's greatest strength lies in its balance sheet. With 3.71 billion pesos in cash and zero debt, the company remains highly liquid and well-insulated against short-term pressures. Its current ratio of 2.12 and growing equity underscore a position of notable financial durability. Maintaining leadership in core categories like refrigerators and washing machines, PMPC faces intensifying competition, particularly from aggressive Chinese brands. The company's operating base is anchored by its manufacturing facilities in Taytay and Stella Rosa. A new factory building project, following a recent fire, and part of a wider modernization plan, signals a commitment to capacity expansion, even with growth temporarily stalled. Capital investments rose sharply, driven by the new Stella Rosa facility and equipment upgrades. These moves may strengthen PMPC's ability to capture demand if the market rebounds, but also carry the risk of higher fixed costs if softness persists. Through improved working capital and tighter cash discipline, the company delivered stronger operating cash flow, 1.35 billion pesos for the year. Lower inventories and receivables show a continued focus on operational efficiency. PMPC now stands at an inflection point. Reliable, profitable, and well-capitalized, it balances the need to modernize with the imperative to remain financially prudent. The path forward will be defined by its ability to turn brand leadership and factory investments into sustainable growth, without sacrificing the conservative foundations that have been key to its resilience.